welcome to the latest edition of BM Talks with me, Helen Thomas, CEO and founder of Blonde Money, and our returning guest, Ben Ashby, CIO of Henderson Rowe. Hello and welcome back, Ben.
Hello, Helen. How are you?
I'm very well. It's a great joy to have you back with us. We are going to be trying to do these quarterly as a discipline, both for me and for Ben, to see how we were getting on and what we were thinking. Now, I'm going to start actually, Ben, with one of the things that last time we spoke in January, I was left very strongly with your impression about energy. You were very embedded in the world of energy. You were looking at a lot of energy stocks. And obviously, as we sit here today talking, the world is now talking about energy. So do you want to fill us in on what you're looking at, what your thesis is, how the Middle East conflict may have changed or indeed just sort of embedded what you were already thinking? So yeah, go for it.
Where do you start? So as you know, I've long held the view that we were heading for a sort of 1970s rerun. And one of the things that triggered off all the problems with the inflation in the 1970s was an energy spike. All the conditions were in place for that before we had the Iran conflict.
Right.
We've massively underinvested in traditional energy. I believe even Tony Blair has come out this morning as we're speaking and saying that Ed Miliband has an ideological view about net zero, which is seriously damaging the economy. And it is seriously damaging the economy. So we've had all of that sitting in place. I think there's also slightly more technical field, but there's a view that the US shale gas was some kind of infinite, non-exhaustible resource they could plug into. I think there's doubts about that. So I think you had a lot of rundown with regards to traditional energy sources. It's a depleting asset. The fields weren't drilled. The new technology doesn't work. And you were just waiting for an appropriate trigger, whether that would have been price or indeed a major war. And that's happened. And I think the shock is real. It's going to be enormous. And I think it's going to last quarters and quarters to work its way through, or maybe even years in some of those cases.
Yeah, so effectively, it's taking your original thesis and it's now building and growing on that. We kind of got that times, well, exponential potentially. Certainly, it's a bit more than times two, isn't it? I guess in terms of what the impact is. Do you want to? Can you delve? I don't know if you can reveal about your portfolio, but do you have a sense? We just talk about the energy sector. Are there any stocks, bonds, sectors, aspects of that world we should be focusing on more that are of value given this extra additional energy shock that you'd want to talk about?
Yeah, can I just start off and just say that the shock hasn't actually hit yet? And that's one of the big problems as we're discussing. So oil at sort of $100 a barrel is still cheap by historical standards. So
actually, really, yeah. I'll tell you, you did say something about this the other day. Where was the peak? Was it 2008? If you adjust it for inflation, what would we be talking about today?
$215 a barrel.
Wow.
And we're at 100.
Yeah.
So it's got a long way to go. The other problem you have as well, and just watching the news and everything, is they quote the spot price, and the spot price is not particularly useful. What you want to have a look at is what's the sort of forward price and the physical delivery. And that's already 50-60% higher than where we are at the moment. So once the ships stop turning up, which is basically this week, they'll start running down what's in the tanks. And we're just talking about oil for Europe and most of our listeners here, which are obviously UK based, or certainly European based. Gas is the bigger problem, and that is structurally a much bigger problem than oil. So that's all still to flow its way through. The thesis that I had was at some point there was likely to be a pivot away from the Middle East for various reasons. I had talked about I thought there was a reasonable chance that the war would restart in the Middle East. It's actually in the US National Security Strategy, which they published last November. And I know we took the time that nobody seems to have read this, that they were talking about dealing with Venezuela. And I think the term they use is resolving Iran, which
yes.
very Orwellian expression. I'm not quite sure how that's working out for them. But
it was part of the plan. This didn't come out of the blue, did it?
No, it was part of the plan. They were going to do it. So we kind of positioned for that. North American oil and gas, Australian oil and gas, what we did initially with a lot of our clients, we linked it closer to the infrastructure. So things like the liquefaction plants that are being built in North America, a lot of the pipelines that are being built in North America. Now you've got the opportunity for an outright opportunity in actually the upstream kind of energy producers themselves and that component. And I think that's potentially something that's going to rumble through for 2 or 3 years at least. Why? Because it's still cheap. You've got this depletion of assets. I can't see people going back to some of the Middle Eastern resources, even if stuff is resolved immediately.
Yeah.
And it's the second big energy shock for Europe now in less than 5 years.
Yeah. Well, there's always talk about Asia, but yeah, the impact on Europe, pretty significant, really. Is there any particular country you would pick up that is more vulnerable, or
Us?
right? And okay, go on. Why is that? Why is that?
No, there's worse countries. I think out of the G7, I think even the IMF's now come out and say we're the most uniquely vulnerable to it, which is quite
Wow.
remarkable given that we should have still substantial domestic resources, which is another thing that kind of annoys me about the argument, where you see a lot of people saying, well, North Sea's tapped out. Well, yeah, that's because the fields deplete and nobody's been allowed to drill for any new fleets, new wells, or even new resources. So of course it just will deplete over time. And then you get the secondary argument of somehow it's going to destroy the planet by drilling, but it won't make a difference at the same time. It just seems to be a lot of people trying to argue why you shouldn't do this. At the end of the day, I'm a professional investor. I should be able to make those choices. Yeah, it shouldn't be a bunch of civil servants. And if I think the opportunities are there, which I think they genuinely are, the market should be allowed to decide, not some guy with an MSc who's never worked in business, commerce, or anything outside of politics, deciding what is appropriate for the UK economy.
Well, now it sounds like we're drifting into political theory of
We are.
free markets, communism versus capitalism, but let's not go too far with that. I want to now take you to some of the specifics of the Strait of Hormuz for a minute, because it might feel like that topic's been done to death, but I think actually there's two elements that you have flagged to me that I've considered to be quite underreported. So the first one is the physical space to maneuver through. So there's a lot of, I think, is it 23 miles people talk about for the actual strait. Now, you're telling me it is, in navigable, operable terms, far narrower than that.
Yeah, it's 6 miles. It's two 2-mile wide channels, and there's a 2-mile gap between the two, because occasionally, as we saw with that big US container ship hitting the bridge, occasionally you get engine problems. So they leave that kind of gap in between for a ship losing power and things like that. So it's only 6 miles. And it makes for a shooting gallery.
Yeah, and talk to me about LNG. So you again, I very rudimentary understanding of the tanker wars in the 80s, where there were actually ships escorted by American naval ships during that period, Iran-Iraq war.
Yeah,
I mean, this is different, and I'm sure you can explain why. But I think LNG is you've said one of the key differentiators and what that actually means. So yeah, tell us about that.
Yeah, if I just go back to your point about the Iran-Iraq war, first of all, the war took place at the northern end of the Gulf, so it was a long way away from the Strait of Hormuz. Secondly, the US wasn't a belligerent, so again, nobody really wanted to upset the US, so them escorting tankers was an issue, because it was basically Iran and Iraq shooting at each other's tankers. So that, again, once the Americans got involved with I believe there might have been some British and other countries' involvement from memory. But it's a completely different geographical location, and it wasn't as tight, and the US wasn't one of the belligerents. So I think that is fundamentally different. The other thing as well is LNG is a relatively modern thing in terms of shipping this stuff around. It's only kind of, it's been around for a while, but it's only really kind of become mass scale in the last 20 odd years. An LNG tanker is liquefied natural gas. It's a bomb. And you've got a really good example of that because the Ukrainians allegedly managed to hit a Russian shadow LNG tanker in the Mediterranean. It's still floating around. The ship was abandoned. Nobody wants to go back on it because nobody knows when it's going to blow up. And that's
right now, isn't it?
That's right now. Yeah.
As we're talking, that happened, what, a week or two ago, was it?
No, about a month ago, and it's just been abandoned.
And
because
still no one wants to go near it.
Yeah, and that's the problem you have. You don't need a lot of damage on. Just think about throwing. You don't throw gas cylinders onto a bonfire. They tell you to do it. It's kind of a similar principle of that. It's a pressurized container that could potentially go bang. So, what crew's going to get on board that, and who's going to want to ship that through? So, that's a big problem, because, like I say, the LNG is the big swing fuel factor, not crude, for certainly Europe and chunks of Asia.
And of course, Qatar, who are the big producer, aren't they, of LNG?
Yeah.
I've got that right. Have It's not just about that. They've had some actual damage to the plant that will take, I think they've said, years and billions to put back together, effectively, to repair back to full production. Is that right?
Yes, it is. So, showing how old I am, I remember when the financing was done first time round, which I helped finance stuff that's now been blown up. Uh, I think they've got something like, it's either high teens or low 20s of the various kind of liquefaction units, and I think they've had about 3 or 4 knocked out, which I think accounts for about 15 to 20% of production, and those things will take several years to bring back online because they are very specialist bits of equipment. I think there's only about 4 manufacturers for them in the world, and they're usually done with long lead times because they don't, under normal conditions, expect these things to be blown up.
Well, and now, if I take back further in time in a parallel, you mentioned the 1970s. Are there any lessons from that that do apply here or don't apply? I mean, there was a political decision there in terms of the oil embargo in the mid 70s. Tell me about that. But also, then I would like to know, from an investment perspective, what did we learn from that that could manifest? There was, I believe, an ongoing issue with the banking sector in that period. Could we be facing anything like that this time around, or is it actually different this time?
Oh, I think we're going to have a problem with the banking sector. It was actually the shadow banking sector in the 70s. They called it it's almost history repeating itself. So they called it the secondary banking crisis. So effectively, British banks could only lend on the strict criteria. They couldn't lend to a load of stuff like commercial real estate, very much what you're seeing with private credit at the moment. A whole bunch of things that were called secondary banks were set up, which would be called shadow banks or, private credit funds, whatever you want to describe them. It's the same concept, slightly different structures. And the big thing that was taken away, it was the interest rate shock. That's what actually blew everything up. It wasn't the oil price per se. It was the fact the oil price fed through into an interest rate shock. And that's where suddenly all these secondary banks got into difficulty. And everybody thought, oh, no, it's fine. They're small. They're kind of isolated. And then people found out that actually some very big banks had lent to these banks because it was profitable. And that was when the problem spilled over. And famously, NatWest had to get bailed out.
Yes, I was
In the
going to ask you
crisis.
some of the names. Can you remember some of those names of those secondary banks? Or, well, maybe not.
Yeah, there
Probably
was
don't
Cedar
fall within all
Holdings
those.
was probably the most famous one.
Ah.
There was a couple of others. So there's names that might come back to me as we're having this
No,
discussion.
no,
But
but it's
NatWest was the big bank that got dragged into
yes.
the problem because they'd gone and lent to it, and that's exactly what a lot of the big banks have done this time around.
Yeah, goodness me.
And
History
and
rhyming.
that's what I think will be the bigger issue. It will be the interest rate movement, and that's what puts pressure across the whole cycle, and that's the repricing of capital, and that's where you get wider problems.
Well, we've obviously had pretty violent moves in certainly UK and EU rate
Yeah.
markets. From what you're talking about, it makes it sound like that's merely the beginning rather than the end. That was maybe a tremor, not even the main earthquake. Is that, or will it be? Do you envisage another? Because that's a pretty quick move we've seen in a lot of these markets, or are you looking at maybe just a sort of ratcheting process, it won't be as violent, but it eventually will get us to much higher interest rates? Or what do
Yeah,
you see for the yield curve?
I think that you've described it exactly. I think we're going to have a ratcheting effect. So there'll be movements back and forth. But if you look, the trend is higher. So people are paying higher rates. And I think that will ultimately feed through to the States as well. Because again, in many ways, it's almost the perfect storm for the Americans because you sort of sit there and they think, well, we're isolated from this. Well,
Yeah.
not exactly. And let's see, you're going to feed through. Plus, you're borrowing a load of money and you're borrowing money in the short end. So very short dated debt. And again, that's the most sensitive to interest rates. So we are going to see, but I think the trend is wider. There was also, it's just worth saying that structurally, what's different between this one and the 70s? 70s was a political thing by OPEC. It could be reversed relatively quickly. This time is structural damage. I'm not clear to me where the resolution is. And secondly, there was a second interest as oil price shock. It wasn't as big a shock because obviously we were already coming from elevated levels, but that was Iran second time round. And I think in many ways that's more kind of constructive about where we are, or more constructive guide to where we are. So yeah, I think it's a big problem.
But if you're talking there, my mind was thinking on this concept of a lot of debt needs to be refinanced. Some of what you're describing is often the hallmark of an emerging market country, which is where you shorten the term of your debt. Inflation, looms. Central banks have to hike, and it just becomes, and then you get a currency crisis. Actually, I mean, could we see that in America, or or could we see it in India? I mean, the rupee is obviously very weak already. They've even, I believe, the RBI has already taken steps to um, regulatory steps to try and prevent too much shorting of the currency. But could we be looking at something like that, EM style in the developed world?
Well, the the developed markets have done a fantastic job of making their balance sheets look like emerging markets, and they're behaving like emerging markets. So I don't see why a lot of them aren't going to have emerging market-like outcomes. The US appears to have replicated Brazil's balance sheet circa mid 1980s, with heavy reliance on short-term financing. But obviously, the dollar is a very different beast to the Brazilian real, or at least I hope it is, and we're going to discover one way or the other, I suspect, quite soon. I think if you start to see higher rates, I think there's a certain point where the US will be forced to intervene, and whatever they call it, you'll get a second round of QE. So I think there is a high probability the dollar will rally for technical engineering reasons. I might be wrong on that.
Capital flows and just
also just
money around. Shortage, when you're in a shortage, it tends to boost the dollar, doesn't it?
Yeah, and I think there's also sort of an unwind. I mean, look at the other stuff that's going on as well. So some of those Gulf states are big sovereign wealth funds, and again, they're going to be liquidating assets, and they're going to be liquidating assets to turn that into cash. So they're going to need to find cash, and they're going to pay for things, whether it's food imports or new stocks of missiles or whatever it is, or new plant to be reinstalled into the plant. So I think there's a reasonable chance we get a dollar squeeze, which I know is not what people think. Medium term, I totally agree with the consensus. The dollar's going to be weaker. But then it comes to the second question. You're an ex-FX trader. Weaker against what?
Well, indeed, exactly. And it's a relative game often, currencies, right? Which is why I was interested to hear you talk about that, because I was thinking, yeah, sure, okay, the US does have this massive debt pile. It does still have exorbitant privilege of reserve currency status. In the world we're describing of a kind of stagflationary environment where there's huge amounts of debt to be refinanced, it still feels to me like the US wins the sort of ugly contest. But I don't disagree. We could see periods of it being bad for the dollar. I mean, the sterling's an interesting one.
Yeah.
I mean, you hear a lot of how gilts are the high beta, and I think we've really seen that over these last few weeks, as in a rally they rally more, in a sell-off they sell off more, right? They appear to really be moving a lot more than well, the bond market's moving a lot, by the way. We should say, for people who are listening to this who are not in the day-to-day of bonds, these are pretty significant moves we've had, right?
Yeah, huge.
Yeah, and it's actually, I'd like to ask you, as someone in the markets every day, liquidity then strikes me. Liquidity must be poor, or is it? Or are people getting things done? It's just there's a lot going through, so you're getting big moves.
The liquidity's poor, and it's deteriorating. So the credit market is significantly deteriorated, which is probably most problematic for, again, that's how corporates and a lot of other things get financed. There isn't. There's bits of the government market that are pretty liquid. But the fundamental problem, think if you're trying to price anything else in the world and your gilt market is moving around, or whatever government bond you're looking at, but gilts in particular, then it's very hard to price anything else because you've got no stability over what, quote, the risk-free rate is.
Yeah, the risk-free asset is moving more than it kind of should, really.
Yeah, you can see like 40, 50 basis points movements, cumulatively over the course of a week. And it's like, well, how can I price a mortgage off that? Well, I can on the spot basis, but you can't make longer term sort of decisions. So the other second thing it kind of triggers as well, it sucks liquidity out of the market, because as the vol increases volatility, it forces people to have higher margin, it forces people to reduce kind of two-way flow. So slowly but surely the liquidity is disappearing and financial conditions are tightening.
Well, that's something else I wanted to pick up on, is this concept of whether we're going into more of a general liquidation period, because on our last talk about a quarter ago, you've got a wonderful bunch of models that you look at. Am I allowed to reveal the name?
Yeah, you can. The cat.
QuantCat. Love it. And in fact, you've got a Substack, haven't you? What's the name of your Substack?
T-bills, thrills and bellyaches.
Very
which
good.
is
Which is
an early, before your time, early 1990s reference to an album.
yes, I know. But I was trying to remember which one. Is it
Happy
is it the
Mondays.
Pogues? Is it
Happy
the Pogues?
Mondays.
I was Happy Mondays. Oh God, lost on my street cred there. And I don't think I had any, but I do. Yeah, I suppose I was more Blur than Oasis, and maybe that's where I've gone wrong in my. And probably Take That as well. So just lost all the
So
listeners
no, not at all,
straight away
because
there.
all of the things we've referenced, including me, even the Happy Mondays, are even older than that. So half our listeners probably don't even know who any of these
Oh
people
well,
are.
yeah, that is true. I know.
Were they around when the Beatles were?
Yeah.
No.
Oh God. But that is a great. Your Substack's great, and you do have QuantCat, and it pulls in all these different types of model. And I seem to remember there was, and wonderfully, it spits it out in words you can understand. And I remember there being discussion of a sort of rounding top or blow off top. I can't remember what it was. You can remember, in the sense that the liquidation measures, all the other quantitative measures that this model looks at, were sort of suggesting we were headed into some kind of topping out on, certainly on, was that US equity markets on the S&P 500? Is that fair way to describe it?
Yeah, that's absolutely fair. It's trained on mainly on US data.
Right.
There's other versions. There's actually a family of models, but effectively they were slowly rolling over, and it's what they call a rounding top. So not
Right.
all stock markets or end at a point and collapse. Sometimes you kind of get this slow rounding motion as it rolls over and then goes into a longer term sell-off. They're often indicative of much deeper sell-offs, because again, it's a general exhaustion of buying, people beginning to kind of wake up, the behaviorism of, what am I paying for? That was what the model was suggestive of. It was
And
slowly.
that was before this conflict.
Yeah,
Came
absolutely.
into view, right? Yeah,
Yeah,
exactly. That was
it's
right at the start of
it's
the year.
got increasingly unhappy since October, November, and talked about a very unstable market. And then March was the thing that just pushed it over. And we could have secondary effects as well. I mean, another thing we've not really talked about, but you were talking about the Substack, but we both do stuff for the CFA. I wrote a long paper on the CFA about the Japanese carry trade, which is again quite a technical aspect of the market. And I just said, look, there is a structural change going on, but it might be quite measured and slow unless there's an external shock. Well, guess what? Japan is very dependent on energy imports, and this looks very much like an external shock.
Yeah, at the moment of its currency being, one of its weakest points for decades, with a new reflationary prime minister.
Yeah,
Quite
and
astonishing.
that could quite significantly start to disturb a lot of other things in the market. So you've got, again, it's the interest rate shock that might just trigger wider problems. And yeah, you've got that as another thing that's laying around in the market that could now potentially go bang.
Does this mean that systemic risk is kind of looming on the, if you were to get, sort of trying to frame the risks out there? Because we have talked about a ratchet effect, a kind of slow motion car crash type thing going on, a general liquidation, but we haven't talked systemic issues, although you slightly alluded to them. But is that kind of on the radar maybe, or still extremely low probability to go to that extreme?
It's a rising probability. Any sovereign distress is systemic. You're not talking about one or two banks rolling over in California. You're talking about countries potentially having significant problems refinancing their debt, and therefore perhaps turning to the printing press, which I suspect they will at some point, which will trigger another round of problems, because then people will start to lose confidence. So it's almost like M&T is just about to get stress tested, and then we're all going to see why M&T doesn't work as a theory, because people will turn around and go, you're printing money because you can't finance your debt anymore. I don't want to go anywhere near your currency or your debt. And that's a significant problem for certain countries. One of it would be us, with 20% foreign investor involvement. So I think slowly but surely we're marching towards the world where we're going to get more printing press finance of a debt. So I think there's enough bits and pieces in there laying around. The commercial property market problems haven't been resolved. They've been slowly cooking off over the last few years since COVID. You've got private credits, probably not enough by itself, but again, with a wider interest rate shock, with wider problems in sovereign funding, I think there's enough things around. I think we're just about to get the bill of the last 15 years of money printing.
Wow, well, you and I have been talking about that for some time, and you kept telling me, "No, no, not yet, not yet. It's not," because I think I probably have a reputation for being bearish, which I don't mean to. I just have I just want to be the one to spot those risks on the horizon. You don't want to. What was it that, the Titanic basically went down because there was a box with binoculars in it, but they forgot to bring the key or something. That's at least one theory I heard. The other one's about steel rivets. Have you heard those theories about why
No,
it's
I haven't. But
yeah. So I want to make sure you've got the binoculars. That's kind of my job. Mostly looking
well,
at
it is. But you also, if you look at your wider client base, I mean, I look at this every day. You look at this every day, but you've got a client base that probably doesn't even understand what to ask or the questions that they have. But the key message is we've created a lot of nitroglycerine. We've left it all around the market in various places, and we finally got somebody running through with a torch. And let's just see what ignites.
Well, then they may well say, but hang on a minute, Ben. There's always somebody rides to the rescue. You mentioned a printing press. I mean, it's kind of, I was just about to ask you, how do you do QE when if interest rates are at 5%? But of course you can do yield curve control, you can do whatever you like. If you want to really go for it, you could do capital controls. You could do exchange rate pegs. There's all sorts of things you could do. But I mean, yeah, that's
Can I sound like a heretic here?
Go on.
I think capital controls need to come back. I don't actually think a world without capital controls has been particularly beneficial. I think it creates a lot of hot money, and I think it's caused a lot of the financial imbalances in systems has occurred because there hasn't been capital controls. And I know it sounds completely heretical.
You shocked me with that. You have shocked me with that.
Yeah. I'm an old Keynesian at heart. I don't mean the 1960s theory. I mean Keynes himself, and he would be the first to talk about you need to pour sand into the wheels of capital, because otherwise money just flows around too quickly. And I think a lot of the structural problems we've got in the UK and the US is because of effectively the trade balance has become so distorted, and we end up absorbing huge amount of foreign capital, which means we ultimately have to sell things or get into debt to finance that. And I think that's caused a structural hollowing out of the industry, which for his many flaws, and we could probably do a week-long podcast on Trump's flaws, but I think there's an element of the US trying to rebalance its current account is totally justified by what's happened. Yeah.
Well, we possibly should do a podcast here on that. Please write in, those of you listening, if you'd like us to do that. Right, okay, I don't want to go on for too long. So let me see what else I'm going to ask you about. Do you want to talk about the Henry Hub gas? You did touch on energy earlier, or do you feel you've covered that?
Probably covered that. And Henry Hub, which is the US sort of onshore natural gas pricing mechanism, is probably a bit too technical for most listeners, but it would be one of the things I would look out just as a second thing if you want to see problems, because I think the US could still avoid a recession at this point. I think it's heading for stagflation.
That was my next question, was the US recession, ?
Yeah, I think all things being equal at the moment, it would take more than this to push the US economy over. I don't think it's in a particularly healthy state, because I think a lot of the growth has been artificial. There's obviously a huge fiscal stimulus going on. But I think if you started to see a general widening of energy problems in the US, I think that's enough to push things over. And I think Henry Hub, which is their domestic gas price, which, by the way, I think is going up anyway over the next 2 or 3 years. But I think if that was to go up significantly in the next few months, that's something that would very quickly have widespread problems in the US economy.
I can believe it. Okay, so final couple of questions. Gold? Let's talk gold.
I think if you're a diehard believer in the thing, it's fine on a medium-term view. And I think that there's money printing coming. But on the short term, I don't want to go anywhere near it for a couple of reasons. So first of all, if you just divide it into two halves, I've always preferred the miners, as you know. I think, look, you divide gold into two sides. First of all, I've always had a problem with the physical side of things because it's a behavioral asset. You look at who buys it, and only 6% of its industrial use. Everything else was basically speculation, or not just quite speculation,
only but 6%. Sorry, only 6% is actual use case of gold.
Yeah, everything else is buying for reserves. Well, why are you buying that? Because the central bank thinks it's a good idea. Okay, well, objective. Where's the scientific merit in that? I know it's got a long-term history, but there's nothing more than behaviorally we put a value on the thing. Then there's jewelry, then there's outright speculation. And that's your 94% of demand. Yeah.
Very keen on this then, except I don't know if people can see. Sorry, I'm showing off my very pleasant Tiffany necklace.
Although it looks lovely.
Thank you. Although apparently the diamonds are worth nothing now, right? Because apparently you can grow them in a lab or something for about £5. You heard this?
Yes,
Lab-grown diamonds.
China has managed.
China has, screwed up my jewelry. Thanks, China.
Yeah, on the gold thing, the other thing is, remember, most gold mines are tapped out. They're usually miles from anywhere for reasons that's where you find gold these days, because all the stuff that used to be convenient has kind of been mined out, and they require huge amounts of energy. You have to ship energy there to do the mining operation, so there's a cost in doing that. And then there's the cost of actually drilling this stuff, which again is pretty much an oil play, because effectively it's a liquid form that the fuel turns up in. And that's now suddenly really expensive. Plus, the price action just told you there was a whole bunch of speculators going on in that market. So I think that there's a reasonable chance of a liquidation going on. And for anyone that wants to look back at 2008, everybody thought the financial system's fallen apart. It pretty much did, until government involvement came in. And gold was therefore a good proxy. It went down by 40% in the short term, because it's, as you've made the point, there's a good chance of a general liquidation. And people just have to sell what people are prepared to buy, and that isn't necessarily what you want to sell. I don't think people have fully understood the energies are across the supply chain shock. It's everything: transportation costs, going on holiday this summer, the cost of your food, the cost of the air conditioning. Singapore this morning is beginning to look into, even Singapore, which is obviously very rich, beginning to look at the cost of energy, because of course they're a heavy energy user because of air conditioning. It's an absolute industry-wide shock, energy.
Yeah, and on the Japan point, I saw this again this morning, that the Prime Minister was saying, well, we think so they're going to release extra strategic reserves to Japan from May, and they are securing as much as they can, from different places. So they hope that by May, they think more than half of their oil imports will not have come from anywhere near the Strait of Hormuz. Now, the flip of that is this is a supply shortage. So if they're getting it, someone else isn't getting it, because there's going to be the price of this stuff. If you can pay to divert the tanker to your ports, it's not going to end up somewhere else, right?
Yep, absolutely. Absolutely.
So it's rich nations might sort of somehow do marginally better, but that's not even necessarily the case. In fact, we should talk about China then, really, because this is a geopolitical shift. Well, it's part of a bigger geopolitical shift that's been going on for some time, but has been accelerating under Trump's second term, as you sort of touched upon. You have recently been to China, in fact, if I may ask you for your sense of how it was. I would like to note that you flew with an airline that could fly over Russian and Chinese airspace, which I thought was a very smart move, Ben, I may say.
Well, it was until the food turned up, and then I started to regret my life choices. I've been to Japan as well. Look, they've both got quite large energy reserves. So the first point you were making is, we'll be paying more. Some countries just won't get it. And so there is a bigger problem for some of the countries. We're the biggest importer, I believe, of jet fuel at the moment from the United States. So again, that's partly because a lot of flights have started to be rerouted through Heathrow instead of Dubai. So it's an ill wind that blows no good, though I'm not sure how much benefit that has for the wider economy. The Chinese economy seems to be a lot slower than the official numbers are suggesting, which doesn't hugely shock me. They have got rising problems with youth unemployment, which again doesn't shock me. Also, the amount of data coming out of China has gradually reduced over the last few years, which is usually not indicative of good news, since less news seems to be finding its way to the outside world, or less statistics. So I think they've got some time, but I think the problems for them are quite significant now. You've got basically a deflationary bust because of property. You've got all the trade problems, and you've got higher energy costs. So I don't think it's a very happy mix for them. Ditto Japan,
well,
where
producer prices just came out and have gone positive. They've been deflation for 3.5 years. Now, that is nominal terms because of these rising energy prices. But you're saying generally it is still a disinflationary, if not deflationary, economy. Is that what you're saying? Because the debt, because of the unproductive allocation of capital, and all of that sort of thing.
Yeah, I think there's been a massive misallocation of capital. And look, I don't even know how you describe it in their case. So you've got manufacturing that they can't make a lot of profit on. It's, as you say, the price has gone up partly because there's an energy component to it. So nominally it pushes it up. And at the same time, you've got a deflationary bust. All in all, it's quite an impressive policy mix. So
you've got all the inflation where you don't want it, and all the deflation where you don't want it.
Yeah, absolutely. I mean, remember, they're a big food importer as well as other things. So again, there are
Yeah.
opportunities elsewhere. So, for example, the big South African petrochemical company, though it's not actually petrochemical, but Sasol hasn't made a profit for years. It's been in a series of restructuring, but of course, all their stuff is derived from coal feedstock left over from the apartheid era. I'm not quite sure where they acquired the technology, but it seemed to turn up around 1945 of turning coal into oil. But that has suddenly benefited them. It's benefiting stuff in South America because, again, it's on a completely different supply chain. So there are opportunities out there. You were talking about the portfolio elsewhere. I'm just not sure that now is the time to go in there. I think now the time is to preserve capital.
Yeah. All right. Well, we will end it there. And thank you very much, Ben. And just to conclude, if anyone has any thoughts, we welcome your feedback. Please do contact me, helen@blondemoney.co.uk, or I am on Twitter and LinkedIn as usual. And thank you very much, Ben. We'll see you again in 3 months' time.
In 3 months' time, who knows what war will be started by then?
Joy, I'll leave you with that. Thank you.